Hello, this is Kopi Time, a podcast series on markets and economies from DBS Group Research. I'm Taimur Beg, Chief Economist, welcoming you to our 152nd episode. Today, we will welcome back Krishna Srinivasan, head of the International Monetary Fund's Asia Pacific Department. The department, known as APD as the acronym, does surveillance, technical assistance, and program financing across 37 countries in Asia. Krishna Srinivasan, welcome back.
Good to be here, Taimur.
I saw you very briefly last week in Washington, D.C., but I hope we can keep you a little longer today. Krishna,
Sure.
we're still in April. It hasn't still been a month since the reciprocal tariffs were announced. So let's start with that. How has Asia absorbed the shock of the April 2 U.S. tariff announcement? And what has been your advice to the countries in your department?
A great question. Thanks, Taimur. So, as you may have noted, Taimur, we have lowered our forecast for the global economy to 3.9% for this year and 4% for next year, right? And this reflects revisions across a many countries in Asia. Now, just to back up a little bit, Taimur, on April 2, if you look at the April 2 tariffs, which were announced by the US, those are tariffs at the highest rate in a century. And why is that so important for Asia? Over the past few years, since the pandemic, growth in Asia has been largely led by, at least in emerging Asia, has been largely led by exports. If you look at the pre-pandemic trend in domestic demand and external demand, you can see that emerging Asia has focused predominantly on external demand-led growth. So exports have been a very major factor in Asia's growth, and a lot of it has gone to the US. So if you take these two factors into account, then with slowing growth in the US, with high tariff rates being imposed by the US, Asia has taken quite a sharp hit. And this is why we have lowered the forecast for Asia to 3.9% this year. And this time represents a downward revision over 2 years of 0.8 percentage points, which is the sharpest reduction we have made in forecast for Asia in a long time. And it also represents a cut across most countries. So we have a lowered forecast for most countries in the region. Again, all related to the heightened trade tensions, the uncertainty which has come with that, and a tightening of financial conditions. Now, the question is, how do we see policy response? What are our recommendations there? What we are saying is, again, this has to be country-specific, so that will be tailored in the context of our Article 4 consultations. But broadly speaking, we're telling countries to allow the exchange rate to move so that it can be a shock absorber. We also feel that with inflation at or below targets for most countries in the region, let's keep aside some countries like Japan, China, and Thailand for a minute. But broadly speaking, inflation is at or below target in most countries. So they have monetary policy space which they could use. Where we are saying we are much more conservative is on fiscal policy, where we believe that since the pandemic, many Asian countries have used a lot of public resources to address the fallout from the pandemic. So now it's a time to consolidate. But even there, we're saying that given the fact that there's a huge demand shock for many countries in the region, they could use some fiscal support to provide targeted but more time-bound support. So in terms of the policy mix, exchange rates to move to be flexible, monetary easing, and fiscal tightening. That would be, if I would sum, again, depends country to country. So this is a very broad presentation of the policy mix.
Krishna, I would like your indulgence to go through parts of the region, like South
Sure.
Asia, ASEAN, and so on. But before I do that, just with respect to the policy recommendations that you mentioned. So typically, a country, when it's hit with a terms of trade shock, an adverse one, is exchange rate acts as a buffer where the exchange rate weakens to offset some of those things. In this particular case, we are talking about your exportable prices going up because of tariff. But in most countries, we have seen actually the exchange rates are appreciating against the US dollar, not depreciating against the US dollar. So to me, that looks almost like a double whammy. What's your
Yes.
sense of that?
I think you're absolutely right in the sense that the dollar has weakened. So this is in that sense, what you have is you have some, you get some offset in terms of financial conditions, which is pretty good. But you're right in terms of the impact on trade. This is clearly a double whammy. You're getting hit by tariffs, demand is slumping, and you're getting the exchange rate which going the opposite direction. But you don't know how much of this exchange configuration will continue going forward. Right now, we're seeing a dollar weakening. There has been a lot of volatility in markets. So broadly, what we're saying is allow when the with exchanges, the issue which many countries face in Asia is that when the exchange starts depreciating, there is some kind of resistance to that in the sense that they feel that it could overcorrect, it could overshoot, there could be too much volatility. So in that context, we are saying allow it to move, and if there's too much volatility, then in some circumstances you could use exchange intervention (FXI) to address that. Again, in select circumstances where there are financial frictions and so on. So that is where I was getting at the time. But I do understand that right now the configuration may not be in that direction.
And just as a general sort of not necessarily related to what we're talking about today, but since you brought up the pandemic, what has been your department's analysis with respect to the usefulness or impact or effectiveness of fiscal policy during those crisis years? Did they do the right kind of job? And I'm sorry, I'm not really sticking to our topic, but since you brought it up, I thought that I'll just ask you that question.
So, in the sense that the whole advice at that time, for our advice was, it's important to protect lives and livelihoods. And I think countries across Asia, they had different ways of doing that. Some spent more, some spent less. Some were, provided, relief to firms. Some provided more to enhance social safety nets. Overall, we found that was quite effective, but that has not translated into a pickup in domestic demand, if that was the question. And yes. I think that's where it's important to think about what could be the longer-term structural, or longer-term, medium-term structural reforms that could underpin stronger pickup, say, in investment, in consumption, so on. I could give examples of where we believe, we can come to that when you talk about individual countries, what kind of reforms would be needed to say, boost investment in certain countries, like, say, for example, in India. So we can come to that. But broadly speaking, they were able to protect lives and livelihoods, but that has not translated into a durable pickup in domestic demand. That's why if you look at the pre-pandemic trend of domestic demand and where you are, there's quite a big wedge there.
Yes, that's exactly the quantity versus quality angle that I was coming in. Very good. Yeah. Krishna, so let's talk about the outlook, given that, you just published a wholesale revision of the outlook for the region. So let's start with South Asia.
Sure. So if I had to talk about Asia, let's start with India. So for India, we have, you wanted South Asia, right?
Right.
Yeah. So for India, we have lowered our growth forecast for this year to 6.2% and for next year to 6.3%. That's a cumulative reduction of 0.5 percentage points since our October forecast. Now, compared to other countries in the region, downward revisions of forecasts for India are smaller. And that's partly, and the reason that India is much less open, and so it's affected that much less by these trade tensions. Now, within India, what we did see is in the second half of last year, there was some slowdown in capex spending, offset to a little bit by a pickup in rural consumption. So even though we're projecting a forecast of 6.2% and 6.3%, one area of worry is private investment. Now, private investment, going back to the point you talked about, Taimur, private investment in India, if you compare to the share of GDP, it does compare favorably with some of the emerging market economies. But the aspects of private investment which you're worried about is investment in machinery and equipment. That's been pretty sluggish. There's been some pickup in real estate, which kind of provides that overall picture of investment not being that anemic. But investment is weak. Private investment is weak. It could be much stronger. And the point we're making is that that's an area where reforms are very important, critical, very critical. For instance, the trade liberalization, which is ongoing, that's important. I think it's important to continue with the infrastructure push, and also important to address labor market reform. These are aspects, if you want to compete as part of China plus one or China plus five, India needs to be able to scale up and pick up in investment. So those are things where I think private investment is weak. It needs to pick up in India. Going beyond India, if you look at Bangladesh, we have again lowered our forecast. It's been down. We are now at 3.8% from 4.5% we had earlier. And that's partly driven by the larger than expected output losses during the period of public uprising, the impact of major flooding, which was clearly a factor, and tighter macro policy mix. Now, there are strains in the financial sector which are also contributing to the slowdown in growth in Bangladesh. And as part of the fund supported program there, we have talked about exchange rate reform, making exchange rate a lot more flexible so that you get a big improvement in the balance of payments. We've talked about the fiscal getting stronger. And finally, there are issues in the financial sector which need to be addressed. So that is, growth is slowing, inflation is coming down. But again, Bangladesh has a huge garment sector, which is affected by the tariffs. And so how that gets resolved will have a bearing on growth prospects for Bangladesh going forward.
Krishna, if I may ask
Sure.
2 follow-up questions quickly. So you mentioned trade liberalization pace having picked up in India. Could you elaborate on that?
So there has been, as part of the budget last year, there was some improvements. There were some announcements there which went in the right direction. But that said, this is an area where we have been talking about for a long time, that India has imposed a lot of tariffs and non-tariff barriers. To give an example of a non-tariff barrier which was imposed, which we think has been quite inimical for exports in India, the whole quality control orders, which was an NTB, which was imposed. So, but the point I was trying to make is that there has been some announcements which are heading that direction, but much more needs to be done. So a combination of greater trade liberalization, an improvement in the labor codes so that India can scale up, and the infrastructure push. It's very important, along with skilling the labor, to have the manufacturing and services-led growth, which could, further boost growth in India and support job creation. You're going to add 8 to 9 million people to the labor force every year. So you need to address both impediments to investment in manufacturing and in services where they've done well. India has done well, but need to continue intensify that effort.
And the second follow-up, Krishna, was in the context of Bangladesh, but I think it applies to India as well. I talked about earlier tariff being a terms of trade shock, but also we're seeing a very favorable terms of trade development with respect to energy prices. Mm-hmm. So do you think just the energy price disinflation alone could open up room for a rate cut in many parts of Asia?
I think if I were to just focus on India,
Sure.
Inflation's come down to a target. It's heading the right direction. You're getting the benefit from lower energy prices. These are oil importing countries. Create space for them to do monetary easing. So I definitely feel that space has opened up. In the case of Bangladesh, I would say, Taimur, inflation is still on the higher side. So they need to continue with that tightening. And one would expect that with oil prices coming down, that should help. But in Bangladesh, compared to India, it's slightly different.
Right. And if we may touch on one of the successful program cases in your department, Sri Lanka.
Yeah, so Sri Lanka, the program is coming along well. Growth has picked up much more than we had forecast earlier. Inflation's come down quite strongly, and the reforms are continuing. There has been a change in administration, but there's more continuity there. And there are some areas where we are concerned, where more action is needed, which is on recovery in pricing of electricity, cost-based pricing. I think that's important. That's one area where, more work is needed, and also on fiscal. But overall speaking, I don't have the forecast number in front of me that was finalized after the VO was published. But my sense is that this is the growth is still holding up. Again, Sri Lanka, don't forget, Sri Lanka also is affected by tariffs, huge increase in tariffs, and they have a textile garment sector which is affected by that. But my hope is that they could work out an arrangement with the US, and that should help address that problem.
Krishna, in the interest of time, I'm not going to force you to go every single country. We'll be discussing this for a while. So let me try to make your life a little easier. Let's talk about ASEAN as a whole, and maybe with some focus on Vietnam, because we seem to be the most vulnerable right now in the tariff scenario.
So thanks, Amber. So on ASEAN, again, we have lowered growth to 4.1% this year and 3.9% next year. Cumulative reduction of 1.3 percentage points. Within ASEAN, Taimur, there are some countries where we revised the growth forecast quite sharply. Cambodia, a cumulative reduction of 4.6 percentage points. Vietnam, 2.9, almost 3 percentage points. And why is that? Both these countries, both Vietnam and Cambodia, their exposure to the US in terms of exports going there as a share of total exports is very large. I think in the case of Cambodia, it's 40% almost. In the case of Vietnam, it's almost 30%.
Yes.
And the tariff rates also very high. I think in the case of Cambodia, it's a 49% tariff rate. In the case of Vietnam, it's about 46%.
46, yeah.
46. So these countries have been affected quite a lot. And going beyond that, we have Vietnam, Cambodia. We also have Thailand, which exports 20% to the US. So there are countries in ASEAN. So ASEAN as a group is affected a lot more. And within ASEAN, the smaller countries have been hit particularly hard. And so that's clearly worrisome.
Would you see that any sort of scope for ASEAN to negotiate or discuss or vocalize their perspective as a region? Or do you see these countries sort of approaching the US on a bilateral basis?
My sense is both is happening. I think they want to also have a unified approach to negotiating with the US. At the same time, they're also talking to them on the bilateral basis. And I think this is particularly important for countries which have been hit particularly hard. So I see. We are not involved in terms of how countries engage with the US, and it's all up to them. But we are asking countries to engage with in a very constructive, productive manner, so that the trade environment becomes stable, clear, and predictable. And whether it leads to greater integration within the ASEAN, that's the other thing we're talking about, Taimur. We're saying that within the ASEAN, the intra-regional trade is only 20%. So there's room for greater integration within the ASEAN that could be a source of support for growth. And also you can think of a cross-regional agreements, say, between ASEAN and EU, which could all help boost growth on a more durable basis going forward.
Okay, let's talk about the big one, China.
Yes. So China, we have revised growth forecast to 4% this year and 4% next year. And that compared to our October World Economic Outlook is 0.6 percentage points of GDP. Now, China is clearly affected. As you know, Taimur, that in the World Economic Outlook, we provided a reference scenario, which is the basis for all the numbers I'm quoting. But we also did a top-down scenario where we assume if the tariff pause is made permanent, what happens? There we see the impact on global growth not being very different, but the tension between US and China are pretty significant, and then China gets hit even harder. So for China, we have revised growth to 4% both years, but risks to the outlook are significantly to the downside. And that's both external and domestic. Now, what we have talked about in the case of China is that it's now even more urgent to rebalance the economy towards greater consumption-led recovery. And there we do hear greater impetus or greater emphasis being placed on that aspect, trying to address the housing sector in a more comprehensive way. That's one part of helping boost domestic demand, because consumer confidence has really plummeted since the beginning of the housing crisis. So you need to address that, which will provide support to consumption. And we also talked about improving social safety nets. Again, Taimur, these are not new policy recommendations. We've been making this for some time, but we feel that this is a time when things could actually pick up in that direction. There has been some improvement in the way they have done pension reform and some increase in rural pension, but again, very small. So they've taken lots of actions in the right direction. These trade-in programs they have for beefing up durable, purchase of durable goods. Right steps in the right direction, but a lot more needs to be done.
Sure. Krishna, when I look at average tariff on imports, China looks pretty good. I mean, I think it's less than 3%. But I think we all know that there are a lot of non-tariff barriers which restrict market access into China. Do you think that this episode that we're going through right now would nudge China into opening up its markets and allow, for example, ASEAN or South Asia to grow through trade, precisely when maybe trading through the US may not be that easy?
So what we are seeing, if I were to flip that, what we are seeing right now, Taimur, is that a lot of Chinese goods are flooding ASEAN markets. So the ASEAN countries are, facing, you can call it triple whammy, getting hit by US tariffs, slowing external demand, and they face competition from Chinese goods. So one could think in terms of, greater integration within Asia that would allow, flow of goods both ways.
Right.
And the question, of course, is how competitive they are. I mean, Chinese goods are clearly very competitive compared to some of the ASEAN countries. So the question is, in the context of greater regional integration and structural reforms, would that allow both-way trade, two-way trade, and help the ASEAN economies? One point I want to also mention, Taimur, is that we see risks of deflation rising in China much more than we saw 6 months ago. That also has a bearing in terms of spillovers to the region, because lower export prices, so they are able to compete very, very well with ASEAN goods, domestically produced ASEAN goods. So that's the other spillover part of the China story.
Okay, since you brought up deflation, it kind of leads me to my next obvious question. Krishna, you and I were actually supposed to have this podcast a couple of months ago, and that time I was going to actually make a very big deal about this because I think you have published some research on this. And the question of, is China heading toward a Japan-like dynamic given its aging and property market distress-related development? So if you could give us a little sense there.
So my sense, Timur, is there are some parallels between China and 1990s Japan. Now, both countries experienced significant property market corrections following unsustainable debt-fueled booms. China is also confronting an aging population, much like Japan has over the past decades, right? So there are commonalities, no question about that. But there are also important differences. Let me highlight that. For instance, Japan experienced a widespread credit crunch and systemic deleveraging, which was driven by collapsing asset prices, which contributed to entrenched deflation. The difference in China is that balance sheet stress so far has been more localized, mainly affecting troubled property developers and local governments. I mean, this is not to say that this cannot spread, but I'm saying right now it's more localized. And the financial system has also remained resilient through the property market correction. Though it has weighed on local government finances, it has dampened consumer confidence and contributed to deflationary pressures. But so far, what we've seen is the stress is more localized. Having said that, I would say that risks of broader deleveraging and what I would call a balance sheet recession in China remain. And one could argue that those risks have actually intensified over the past few months. And in particular, if you expect weaker than expected domestic demand than what you're talking about right now, amid high corporate and sovereign debt, you could see these macro financial loops spreading, and that could be a significant problem. But at this point, it's more localized. Risks, of course, have risen. So that's what I would say. And in that context, I think our policy recommendation in terms of boosting domestic demand becomes hypercritical. Right? So
if I'm
go ahead.
Please go ahead.
No, please.
I was just going to say that if I may share one perspective that I have sort of developed over the years is that the Japan boom and bust cycle somewhat coincided with a bit of a sunset of Japan's industrial prowess. That in the 80s, Sonys of the world were, capturing the mind of the global imagination in terms of bringing cutting-edge electronics. And it seems like by the 90s and 2000s, when the smartphone revolution came, Japan sort of lost its way. I feel that China is not quite in that direction. They're actually improving in terms of creating more more higher value-added products and going up the tech spectrum and having more success on research and development. And given that, at the end of the day, innovation is sort of the elixir of total factor productivity, I feel that at least from that angle, with all the macro points that you made, taking them 100% on board, but just from that angle, I feel a little more optimistic about China today than Japan was at that time.
I would agree with you. I said that the amount of innovation you see, whether it's in EVs, whether it's in battery technology, all high-tech thing, they have definitely moved up there, and that is continuing. This is not to say that firms aren't, you have creative destruction in China too. So every BYD you hear, there are these EV companies which are closing down. So there is competition happening. And there is technology, and they have moved up, and so clearly I agree with you. I would not disagree with you there at all. What I'm saying is, from a macro perspective, you want to avoid the deflation risk. And that's where it's important to think in terms of what could be the policies which will go in that direction. And we've been very clear about how much you need to spend on property, what they need to do on building social safety nets, and what they need to do to address productivity and so on. So those things, if they do, again, we've said our medium-term forecast for China is 3.5% by 2029. If they do all the reforms you're talking about, you could get about a percentage point higher growth in China over the medium term.
They would welcome that very much, given all the headwinds they're facing. Krishna, let's move to North Asia, which is, of course, a very critical part of the global high-end electronic supply chain, and of course, a bunch of countries that are very aligned with the U.S., Korea, Taiwan, Japan, and so on. So some views there.
So on Korea, again, you will have noticed that we have revised our numbers quite significantly. It's a 2% cumulative 2% point mark down. We are at 1% this year and 1.4% next year. And in some sense, we made our projections before the Q1 came out, and the Q1 was very weak compared to market. And here we feel that and Korea is being hit by two forces. One, of course, the external demand, the whole trade tensions, the trade uncertainty, all that is there. And given the fact that they're very integrated in global supply chains, and they are equally risk at both the US slowing down and China slowing down. They're highly integrated with China too. So they're getting hit on the external demand, but also domestic uncertainty, from the politics, which has contributed to confidence coming down and so on and so forth. So Korea gets hit quite sharply. They do have fiscal space to provide support to the economy. They do have monetary space. So in some sense, growth markdowns, downside risks are there, but they have the policy space to support the economy. What's the other country you mentioned?
Japan and Taiwan. To some extent.
So Japan too. Japan, it's in some sense we have growth at 0.6% for next year, which is a pickup from 0.1% in 2024 and 0.6% next year. So Japan, we have marked down a forecast, but the growth is better than what we saw in 2024, and they are converging to a new equilibrium where we expect inflation to converge to the 2% target by 2027. So they are in a reflation phase, and it's coming along well. We talked about how monetary policy needs to be data dependent, and we've pushed out how many hikes they have this year, which we earlier had more. Now we've pushed it out to one way at the end of the year. So those, in a nutshell, are a thing. My sense is Japan and Korea are also two countries, along with India, making more progress in reaching some kind of agreement with the US in terms of the frameworks and so on. So I think I'm optimistic on that front. But yes, growth slowdown in Korea is quite substantive for us.
Would you think that, of course, generally speaking, debt deflation is unwelcome. We want the countries to, avoid the risk of zero bound, which seems like, Japan has managed to do that. But now going forward, it'll still be very important to keep real interest rates very low, given the huge burden of debt they have, right? And how does one manage that?
So it is. Even now with with some normalization you've seen, it is on the lower side. The monetary policy is pretty accommodating, and so in that sense, they are managing that. I think my big concern in Japan is with monetary policy normalization and longer term interest rates going up. What do they do with the fiscal? And there, I'm a bit concerned in the sense that there needs to be greater thought being given to fiscal consolidation, having a well specified medium-term framework, which they don't have to address the fiscal issues. So that to me is a concern for sure.
There was a time, Krishna, as you know, I used to cover India when I was program economist in the IMF, and the question used to be always that India doesn't have too much debt held by foreigners, so why does it matter? It can always print its way out any debt burden. And at that time, we sort of pointed out that despite debt being domestic currency issued, it mattered because the interest spending by the government of India was more than combined spending on health and education. So that's the kind of stuff, especially Japan, as it ages, fiscal demands would rise. You don't want the interest payment to sort of crowd out all the other needs.
Exactly. That's exactly the point. And in the case of India, that argument, they have been very fiscally prudent. They have managed the fiscal quite well, not just in terms of numbers, which again clearly they have put a new, the way they've provided guidance to the medium-term debt. I think that's very good. They've also made fiscal accounts more transparent. So on the fiscal thing, debt, India is doing very well. despite elections, they did not. They kept a prudent fiscal stance. So I think that those are lessons which they've learned from the taper tantrums what they saw at that time. So I think that fiscal part, I think India is doing very well there. In terms of bringing debt down and giving guidance, that's good. We would like to see something similar in the case of Japan, where debt levels are much, much higher.
Krishna, East Asia and North Asia over the previous decades have thrived on an export-led growth model. Now you have the likes of India who want to join that fray, industrialize heavily, manufacture superpower, and then become an export-oriented economy as well. But you and the IMF for the last 2 years have been writing about the cost of geoeconomic fragmentation. As the world sort of turns inward, your argument has been that it sort of shaves off potential GDP growth rate for the whole world. It's a net loss for the entire world economy. So is Asia sort of losing its plot that all these decades of prosperity through trade it's about to come to an end, or you remain constructive that there's still some game there?
So that's a great question, and I think if I were to tell you, my bottom line would be that countries need to follow a balanced approach to growth. In fact, that's what we are pushing for, saying that in Asia, which has relied a lot on export-led growth, especially in the last few years, it's actually intensified. It needs to find a more balanced model approach to growth, relying more on domestic demand. And that's the case not just in China. I think many countries need to need to pivot more towards domestic demand. I'm not saying that growth is that model is completely over. You can still have growth going through exports by greater integration, both intra-regional and cross-regional integration. You could have that diversification of export markets. All the potential is there. At the same time, you also need to think in terms of rebalancing towards a more balanced growth model. And that's where I feel that countries in Asia can still have strong growth, but they need to undertake some structural reforms which can underpin that domestic demand. And I think there's huge potential there.
Right. I want to talk to you a little bit about the US dollar question. Region is trade dependent. Trade is largely invoiced in US dollar. There are some parts of the region that has a lot of dollar liquidity, other parts of the region that don't. You have a set of lending arrangements that countries can use if they have balance of payments crisis. ASEAN +3, the Chiang Mai initiative was set up also. It's in conjunction with the IMF. So there are some emergency taps, if you will, available in the region for dollar. But overall, with the U.S. authorities also sort of giving somewhat mixed signals about what they think about the dollar's fair value and whether it should appreciate or depreciate. You just mentioned about making demand more balanced between domestic and external. Should there be a more balanced holding of hard currencies between U.S. dollar and maybe some other hard currencies?
So you see some of that already happening, but it's a very gradual way. And for the most part, the US is a reserve currency. You look at trade transactions across the world, including in Asia, it's all dollar-based. You look at oil, it's all dollar-based. So that will continue. Some shift may happen. It's going to happen in a very gradual way. So I think that's something which you see more talk. But the science, if you look at the hard numbers, the change has been pretty contained. And over years, just like we diversify, that diversification will happen. But my sense is it's going to be much more gradual because, what are the other currencies you can diversify into? Are they open? Are they liquid? Are these? Do you have? There's nothing like the dollar right now, right? In terms of the open capital account in the US, you don't have that if you think in terms of Asia. So I think that's a process which will happen over the years. But now I don't see a fundamental shift happening in the next few years.
Right. May the open U.S. capital account remain open. Final question, Krishna. I want to sort of leave economics aside for a second and talk about financial sector. What's your sense of financial sector stability risks in Asia, especially given what's happening right now? We've seen quite a bit of unrest in global financial markets in the last couple of months.
So if you look at what's happened to financial markets, Taimur, I would say equity markets have been a lot more volatile. If you look at bond spreads, if you look at currency movements, they've been much more contained. The one issue which, if you look at Asia's share of global debt, I'm talking about all debt, corporate, household, it has gone up quite a lot between the GFC and now. So the question is, this is not a systemic thing across the region, but there are some countries where household debt is high. They need to be worried about that. They should be careful. Korea is an example. In some countries, you have public debt, which is very high, China, Japan. So it's not a uniform distribution of debt across these countries, but there are spots which have to be carefully monitored and so on. Given the fact that over the last 30 years, since the Asian financial crisis, both policies and institutional frameworks in Asia have improved significantly. I'm less concerned in terms of financial stability risks. Yes, there are countries where some of these debt levels are high, but they have to be monitored. But I think those risks are more contained than ever before.
Right. And especially if we're talking about inflation risk, more of a US thing, and for the rest of the world, it's like disinflation or deflation risk. So I think the risk of, interest rate spike around that is fairly small.
Exactly.
So yeah, fingers crossed indeed. Krishna, I know you had an extremely busy last week during the spring meetings, and I know your busyness is not over this week. You have a lot of work to do. So I really, really appreciate that you took the time to talk to us.
Always a pleasure, Thaimur. Always a pleasure.
Thank you, Krishna, and thanks to our listeners and viewers as well. Kopi Time was produced by Ken Delbridge at Splice Studios. Violet Lee and Daisy Sharma provided additional assistance. It is for information only and does not represent any trade recommendations. All 152 episodes of the podcast are available on YouTube and on all major podcast platforms, including Apple, Google, and Spotify. As for our research publications, webinars, and live streams, you can find them all by Googling DBS Research Library. Have a great day.